On Monday, the 17th of August, 2026, if you opened any finance app, the story was memory chips. They were ripping while the rest of the market sat flat. Sandisk up about 9%, Micron up about 4%. It looked like the start of something. By Tuesday afternoon, every bit of it was gone, and then some. Let me show you the round trip, because the shape of it is the whole lesson. Micron closed Monday up about 4%. On Tuesday, it fell about 7%. Sandisk went up about 9%, then down about 9%. If you read Monday's headline and bought on Tuesday morning, you are now below where the move started on Friday. And this was not one company having a bad afternoon. The Philadelphia Semiconductor Index, which tracks the chip industry as a group, fell about 5.5%. The Nasdaq fell about 1 1/3. When a whole industry moves together like that, it is usually not about any single business. It is the mood changing about the entire theme. Now, anybody can explain a fall after it happens. That is the easiest writing in finance. The genuinely useful question is different. What could you actually see on the page before Tuesday, without knowing what Tuesday was going to do? This is our Micron page, captured at 27 minutes past 3 that Tuesday afternoon. Two readings matter here, and they sit right next to each other. The valuation verdict at the top, and the recent trading trend underneath it. The verdict says premium, with caution. Underneath it, one line that matters more than it looks. The price is almost 68% above its own 200-day average. That average is just the typical price over the last 10 months or so. Nearly 68% above it means the stock had run a very long way, very fast, from its own normal. And here is where I want to be careful with you, because this is exactly the point where most channels would overclaim. That reading did not predict Tuesday. Nothing predicts Tuesday. What it described was how stretched the price had become, which tells you something different and more useful. It tells you how much cushion was there if the mood changed. When a price has run that far above its own trend, there is very little. But a falling stock is the easiest place in the world to write a one-sided story. So look at the rest of the same page. The price-to-earnings ratio is 21, against a semiconductor industry median of 47.7. On that comparison, it is not expensive at all. The company holds more cash than debt. The bankruptcy risk reads safe, and the accounting quality reads clean. So which is it? Both. It is expensive measured against its own 10-year history, and unremarkable measured against the companies it competes with. Those are two different questions, and they are allowed to disagree. Anyone who tells you a stock is simply expensive, full stop, is skipping the part where you have to ask, expensive compared to what? One last detail, and it is a good one. Our trading trend score went from mild buying on Monday to selling pressure on Tuesday. One day, one flip. But the same page still showed the stock well above its longer-term trend line. So this was a hot stock cooling off, not a business falling apart. Those feel identical on a red day, and they are not the same thing at all. So here is what I would keep. The news tells you what happened today, and it is very good at that. What it cannot tell you is what condition you were already in when today arrived. Whether the price had run far ahead of its own history. Whether the business underneath was strong or fragile. Those are the things you can check before a Tuesday, not after one. And now you know where to look. Visit us at smartcharts.co, where we explain the stock market in plain English for people who were never given the manual. Nothing here is financial advice.